Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Welcome back to Intelligent Investor Insights. I am Bob Barone, and today we are looking at a story that is flying under the radar of most equity investors, but is sending shockwaves through the credit markets. It is the question of whether the federal government will end up holding a major stake in the artificial intelligence industry. We have transitioned from wild hypothetical scenarios to very concrete proposals twice in the past year, and the structural implications for your portfolios are enormous. Josh, where should we start with this?
Good to be here, Dad. I think we have to start with the timeline because the shift in rhetoric is just fascinating. In November 2025, OpenAI's then Chief Financial Officer, Sarah Friar, floated the idea of a federal backstop for artificial intelligence infrastructure investment. It was a massive trial balloon, but she had to walk that comment back within a week because of the immediate political pushback. Fast forward to July 2026, and the Financial Times reports that OpenAI CEO Sam Altman has entered early talks to give the United States government a 5% equity stake in the company. If you do the math on their current valuation of $852 billion, that is about $42.6 billion. It is a completely different mechanism, but it comes from the same place of absolute financial necessity.
Exactly, Josh. And let us be clear about what is driving this. It is not some sudden burst of patriotic generosity from Sam Altman. This is driven by the sheer staggering scale of the underlying build-out. When you look at the actual numbers, they are almost incomprehensible. Hyperscalers have raised roughly $350 to $360 billion in debt over the past 5 years, specifically to fund artificial intelligence infrastructure. That is data centers, high-performance chips, and regional power grid upgrades. And for 2026 alone, the combined industry capital expenditure commitments are running to approximately $725 billion. Let that sink in. Nearly $750 billion in a single year. Numbers of that magnitude move through credit markets, equity indices, and municipal grids, and eventually they find their way into the retirement accounts and family trusts of everyday investors.
And that is why we are talking about it today. My clients in Reno are constantly asking me if they should be chasing these massive artificial intelligence trends. And my response is always the same. We have to look through the hype and understand the capital structure. The public already has a massive stake in this hardware layer. Think about the CHIPS Act of 2022, which allocated $52 billion in federal funding for semiconductor research and manufacturing. That was a direct government intervention in the physical layer of tech development that happened years before these bailout or equity stake discussions ever hit the headlines. But this new proposal, this idea of a 5% equity stake, is modeled on something entirely different. Altman is reportedly pitching this as a vehicle similar to the Alaska Permanent Fund. They even laid the groundwork in their April 2026 policy paper titled Industrial Policy for the Intelligence Age, where they proposed a public wealth fund to provide every citizen with a stake in artificial intelligence-driven economic growth. What is your economist take on that, Dad?
It is pure, unadulterated marketing spin dressed up as public policy. It is a brilliant public relations maneuver designed to buy political goodwill at a time when the industry is facing unprecedented regulatory scrutiny. Think about the sheer administrative absurdity of this. You would have the federal government holding a massive $42 billion minority equity stake in a private technology monopoly, while at the very same time, the Department of Justice and the Federal Trade Commission are actively investigating that same company for antitrust violations. It is completely dysfunctional. It creates a massive conflict of interest where the regulator becomes the shareholder. But more importantly, from a financial perspective, we have to look at the difference between an equity stake and a backstop. An equity stake does absolutely nothing to protect existing investors from downside risk. If this massive capital expenditure cycle falters, a 5% equity stake does not absorb a single dollar of loss. The government would sit alongside private investors as a co-owner, not beneath them as an insurer.
That is a critical distinction that most people are completely missing. An equity stake is not a bailout in advance. It is basically the industry saying, hey, we want your political protection, so we will give you some paper equity in exchange. It is like a tenant who is running low on cash flow, coming to the landlord and saying, I cannot pay the full rent this month, but how about I give you 5% of my GarageBand's future album sales? The landlord wants cash, not promises of future upside. And right now, the entity that actually holds the leverage is the credit market. Let us talk about the timing of this capital expenditure cycle. Historically, infrastructure investments run several years ahead of the revenue they are meant to generate. We saw it with the railroads in the 19th century, we saw it with utilities, and we certainly saw it with the telecommunications networks in the late 1990s. The big question for artificial intelligence is whether enterprise adoption and consumer usage can scale quickly enough to validate this $725 billion annual spend before the credit markets lose their patience. And if you want a real-time gauge of how patient those markets are, you do not look at tech stock prices. You look at corporate bond spreads.
And that is exactly where the stress is starting to show, Josh. The bond market is the ultimate truth teller in finance. It does not get distracted by flashy product demonstrations or charismatic chief executives. It cares about cash flow and debt service. And right now, the bond market is sending a very clear warning signal. By mid-July 2026, hyperscaler credit spreads widened to roughly 153.5 basis points over treasuries. That is a significant jump from just 118 basis points back in February, and it represents the widest level since we began tracking this specific basket of hyperscaler credit. We are seeing the same repricing show up in credit default swaps. Oracle's 5-year credit default swap rate reached roughly 75 basis points in mid-July, which is a 7-year high. Meanwhile, 5-year credit default swaps for Amazon, Alphabet, and Microsoft widened to roughly 49 basis points, their highest levels since 2018. When credit default swaps widen like that, it means the market is pricing in a higher cost to insure against a default on that debt. The risk profile is changing in real time.
And it is not just a temporary blip. If you look at the institutional analysis, Morgan Stanley Investment Management released a report on July 20th, 2026, describing this artificial intelligence investment cycle as likely to remain modestly credit negative in the near term. They are projecting that investment grade bond issuance from these tech giants will rise 30 to 50% in 2026 alone, reaching roughly $130 to $150 billion. That is a massive supply of new corporate debt hitting the market to fund these data centers. And remember, debt carries a real recurring interest cost. This brings back some very painful memories of the late 1990s telecom build-out for me. Back then, we had telecom companies laying thousands of miles of fiber optic cable, raising billions in debt because they assumed demand would grow exponentially overnight. When that demand lagged, those companies went completely bankrupt. The original equity holders got wiped out. Now, the physical fiber stayed in the ground, and it was eventually bought for pennies on the dollar, which actually enabled the internet boom of the mid-2000s. But the people who funded the original build-out paid a massive price. They paid a very expensive tuition.
That historical parallel is spot on, Josh. And it brings us directly to the internal financial constraints that we analyzed in our June 2026 research report at Universal Value Advisors. We looked at the financial constraints of achieving artificial general intelligence. And what we found was that the industry's own capital structure, not government intervention, is the absolute binding constraint on how fast this build-out can proceed. By our calculations, the largest artificial intelligence developers are already committing roughly 94% of their post-payout cash flow to existing capital expenditures, share buybacks, and dividends. 94%. Think about how narrow that margin is. It leaves almost no discretionary cash left over for further speculative $100 million plus training runs. Any spending beyond that tight margin means they have to issue new debt. And as we just established, the credit markets are already charging a higher premium for that debt. So when you see Sam Altman floating these ideas of a government equity stake, or Sarah Fryer talking about a federal backstop, they are not acting from a position of strength. They are reacting to the reality that private capital capacity is hitting a major wall.
Exactly. They are looking at that 94% figure and realizing that they cannot keep this pace up indefinitely on private balance sheets alone without seriously damaging their credit ratings and driving their borrowing costs through the roof. This is why we tell our clients that managing portfolio risk is about preparation, not prediction. We do not need to correctly forecast whether the federal government actually goes through with a 5% equity stake, or whether the optimistic growth case or the pessimistic displacement case wins out over the next 10 years. Our job is to engineer portfolios that are precise enough in their risk sizing and patient enough in their time horizon that the eventual answer does not determine whether our client's wealth endures. When I look at client portfolios today, I am performing deep look-through analysis. You might think you do not have much exposure to this artificial intelligence cycle because you do not own individual tech stocks. But if you own broad market index funds, or if you are invested in private equity funds, or even certain real estate and utility allocations, you are indirectly exposed to this massive capital expenditure cycle. It is all interconnected through the credit and debt markets.
That look-through exposure is the silent killer for many multi-generational portfolios, Josh. Investors treat their holdings like isolated silos, assuming that their conservative bond funds or utility holdings are insulated from technology risk. But when hyperscalers are flooding the bond market with $150 billion of new issuance and credit spreads are widening across the board, it affects the pricing of all fixed income assets. It drains liquidity from other sectors. That is why disciplined risk management is so critical right now. We cannot control what policymakers in Washington decide to do, and we certainly cannot control how much debt tech executives choose to pile onto their balance sheets. But we can control our own asset allocation. We can make sure we are holding short duration credit that is protected from rising yields. We can hold high quality real assets with reliable cash flows. And we can maintain a healthy cushion of liquidity so that we are in a position to buy undervalued assets when the inevitable correction occurs. We do not chase the market FOMO, and we do not base our investment strategy on speculative government bailouts.
That is the core of value investing, Dad. Underwrite for the apocalypse and try to buy $1 for 50 cents. If this artificial intelligence build out does end up experiencing a massive capital destruction cycle, the physical infrastructure, the data centers, the fiber, the chips, they are still going to exist. Just like the telecom fiber existed after 2000. The opportunity will be in buying those productive assets at a massive discount after the current equity holders get wiped out. But you can only do that if you have the discipline to stay patient, keep your dry powder ready, and refuse to play the momentum game. It is about playing the long game and protecting generational wealth. Well, this has been an incredibly important discussion, Dad. It is always good to break down the actual credit data beneath these massive headlines.
Always a pleasure, Josh. The numbers do not lie, even when the public relations campaigns try to cover them up. Thanks to everyone for tuning in to Intelligent Investor Insights. We will see you next time.
Take care, everyone.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member of our team, Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.